We're back on Morning Trade Live. It's the most wonderful time of the year. It's also one of the busiest times of the year for airlines. The FAA anticipating the busiest Thanksgiving travel period in 15 years, and now the focus moves to late December. The JETS ETF is near 3-year highs and is up nearly 60% from its April low. So let's go inside out on airlines this morning. Joining us now is Jarrett Bilous, Airlines Managing Director, S&P Global Ratings. Thanks so much for joining us today, Jarrett. So what are your expectations? We've got Thanksgiving out of the way, in the rearview mirror now. What's the setup for Christmas?
Well, thanks for having me. I would say heading into the holiday season, demand looks pretty healthy. I think we've had some limited disclosure, but a couple of the airlines have highlighted that they expect that demand trends are going to be healthy, finishing off Q4. And that's following the government shutdowns, which have impaired some of their earnings for this quarter. But I think overall, the backdrop is pretty healthy, finishing off the year and heading into 2026.
What does healthy mean? Because, the narrative for these airlines for the most part of this year has been that they're managing to fill the front of the plane. So I'm just wondering, what we're sort of expecting to see as far as the holiday season, whether that's going to continue or whether there's going to be anything sort of different about this particular season.
Yeah, it's a good question. I would say healthy means relatively stable fares at modest levels of growth, and that's following some pretty steady growth that we've seen through much of this year. So I think overall, if you take out some of the one-time items that we've witnessed, overall the market is still growing. Passengers still want to travel. Clearly, there's above average growth in the front of the cabin, as you mentioned. And I think that's going to go a long way to supporting improvement in credit profiles, or at least earnings profiles heading into next year for many of the players that we cover.
So you say the pressure is likely to continue to face airlines, particularly when you're talking about the sort of middle of the plane, at least the main cabin there. I'm just wondering, how long you anticipate this to go on for? I mean, do you sense we get some sort of improvement next year?
Yeah, it's really hard to say, and it's a question we've been asked a lot. And I think at this point, the expectation is that we will continue to see growth in the premium offerings that a lot of these airlines, particularly the network carriers, have. It's been a couple of years now of pretty steady above average growth, and there's really no signs of it easing, at any point. Surely at some point you could expect growth to normalize, but all of the airlines are continuing, or at least the vast majority of the airlines are investing in some shape or form and trying to promote more premium services, because effectively that's the biggest area that they have to grow their margins, given that the basic economy offering in the current inflationary environment doesn't provide a lot of, if any, profitability.
I asked somebody in the retail space this question yesterday. I'm going to put it to you as well because, obviously this is all about the consumer right now. It seems like we've seen some upside surprise here for the airlines because expectations were just so low at the start of the year. And so obviously we've seen, some good earnings coming out and, the market very much being, sort of somewhat taken aback by what we've seen as far as the improvement is concerned. I'm just wondering, as we head into next year, does it start to get somewhat more demanding?
Great question. I think it could. I would say there's been a high degree of resilience, perhaps, that a lot of the airlines have demonstrated through this year, given that we started the year of a much softer than expected demand environment. Capacity was trimmed, and that led to a tightening of the supply-demand balance, heading out in the late summer and into, the latter part of this year. So I think there's been some industry discipline that's been supportive of relatively stable environment for fares, for example, which frankly should potentially, it's surprising that they haven't, gone up more than they have when you consider that there's been some disruptions in the market. There's been some capacity tightening on certain routes. And the fact is, prices haven't really changed over the last couple of years. So when you think about it on an inflation-adjusted basis, they're actually down. So, it's arguable that that's part of the reason why we continue to see growth in the environment. And I think heading into next year, even though we're a little bit more cautious on consumer spending and the macro picture, there's still enough factors to support our expectation that we'll see growth through next year.
All right, great preview for us ahead of the holiday season. Thank you so much, Jarrett. We've got to wrap it up there. That is Jarrett Bilous, Airlines Managing Director, S&P Global Ratings. Appreciate it. Let's trade it now with Tom White, host of Fast Market. So you've got an example trade for us this morning for Delta Airlines, Tom.
Yeah, Sam, we've seen the stock kind of spike up here to 10-month highs on the back of maybe some better metrics. And this is a really choppy type of sector. You got to keep that in mind when trading the airlines, even though things can look a little bit better on paper. They don't equate maybe to stock moves, but we've seen a nice rally back. You start looking at this name, starting to get back to those all-time highs. That may be an area of concern. So I looked at a strategy that takes advantage of, if you still want to own the shares, collect some yield, 1.1% dividend yield on this stock while still owning the shares, and then you can create some yield in the option market also. So I looked at a neutral to bullish covered call strategy where for every 100 shares of stock that you buy in Delta Airlines, you can sell an out-of-the-money call against it to decrease your break even and also create some yield on the position. I looked at for every 100 shares of stock you buy, you sell one of the December 19th, the monthly options that expire in 15 days, the 70 strike call. That's out of the money by $2.50 or so. Here, you're going to pay roughly about a debit of $66.10. It might be a little bit higher than that right now. The stock has continued to move higher. But the debit you pay is also going to be your break even. Now, this is capital intensive, right? Because you're owning the shares also. But you're buying the shares at nearly a 2% discount to where the stock's currently trading. So there's that yield that you're creating by selling the upside call. Now, it caps some of your gains because you're short the 70 call. So if it rallies through there, you might get assigned on those and your shares taken away. But you can always roll or adjust those short calls. So this is a type of twofold trade where, hey, you want to own the shares, but you want to collect some yield on it with the stock just about 3% below those all-time highs, and then that ability to roll or adjust that short call on a weekly or monthly basis. That creates credits, lowers your break-even point, and increases potential profitability on this neutral to bullish covered call strategy.
Okay, a good look at Delta ahead of the holiday season. We are sitting up about 0.6%. In fact, the outperformer on the day amongst a sea of red there for some of the other airlines. Thanks so much for the example trade, Tom White. I'll catch you a bit later.